episode 81 of Mo Money, the investing economics show for millennials by a millennial, where our goal is to educate, entertain, and empower a new generation of investors. I am, of course, the host, MC Mo. Now, let's get to the money. Now, there is this great episode of Family Guy when Death comes to collect Peter. Peter makes a run for it. Death chases after him, slips on some ice. Death sprains his ankle, leaving him out of service for a few days. Peter takes advantage of Death's incapacitation by jumping off a building, drinking 300 beers, and starting a gunfight, all for fun. With no consequences, Peter was incentivized to act out in the most extremely reckless ways that he could come up with. So, what's the point of this example? Well, let's get to this week's topic, moral hazard in the financial markets. Now, moral hazard occurs when someone is incentivized to act in a way that most would deem either irresponsible, reckless, or even illegal in search of some profits or benefit. And they act in this way because they know if things go wrong, others, not themselves, will be the ones who have to bear the cost. Here are some examples of moral hazard in the banking and the financial system. First, the financial crisis showed many examples of moral hazard that plagued and continue to plague the system, but a lot of them stem back to former Fed Chair Alan Greenspan, who was known for being very accommodative with the Federal Reserve's monetary policy. Anytime the markets were in panic, Greenspan would lower the federal funds rate, i.e. the amount it costs banks to borrow money. These types of actions by the Federal Reserve encouraged excessive risk-taking in the markets because they were essentially being told by the Federal Reserve, if things are starting to go south, we will come to your rescue. In 1998, LTCM was a hedge fund created by two Nobel Prize-winning economists, and they were considered to be the elite, geniuses, and at the beginning, they were killing it. But then after some bad bets and unforeseen crises, they lost over $5 billion in a few months. To prevent chaos from gripping the market, the Federal Reserve Bank of New York persuaded LTCM's creditors and a few of the large banks to bail out the hedge fund. This set the standard for what was to come during and after the financial crisis. In 2008, as the financial markets were in full meltdown mode, the moral hazard that had run rampant on Wall Street had become more clear. Fannie Mae and Freddie Mac, which are pseudo-government agencies, had been buying up every mortgage from the banks that they could find. This created excessive lending to prospective homeowners. Essentially, banks knew if they could give some guy Bob on Main Street with terrible credit a loan on Monday, Fannie or Freddie would buy it by Tuesday, and it's no longer that bank's problem anymore. So there was moral hazard by these banks to give everybody loans because they weren't going to be responsible for them and waiting for the people to pay them back. In 2003, George Bush had signed the American Dream Down Payment Act, designed to help new homeowners afford homes, which is a good look for a president. So Fannie and Freddie were incentivized to act this way because they had the government's unlimited funding and politicians wanting strong housing growth so they could get reelected. The banks were incentivized to give mortgages and buy and sell products involved with this mortgage frenzy because the mortgages were essentially government guaranteed, aka the banks were operating under the impression that these mortgages would be paid no matter what. So there was zero risk for them. If the people paid, perfect. They make money. If they don't, the government steps in and pays them anyways. Boom, it's a win-win. The Federal Reserve made money very cheap for the banks, so this also encouraged lending and excessive risk-taking. And as I said before, the precedent set by LTCM crisis signaled to the financial markets, do whatever the fuck you want, be as wild and crazy as you want, the Federal Reserve will always come to save you. But in the end, as they suspected, the Federal Reserve did come to the rescue with taxpayer money to the tune of $700 billion. They had acted irresponsible, they knew they were acting irresponsibly, they knew they could get away with it, and they all did. Now there's some other examples for the case of moral hazard. The Federal Deposit Insurance Commission, FDIC, creates incentive for banks to be more risky with depositors' money because if things go wrong, the government will refund the depositors. The government guarantees student loans causes university to increase tuition prices higher and higher every year because they know they'll be able to get the government to spend that money on these tuition prices. So what can be done to prevent these moral hazards in the financial markets? Well, a full answer to this question would really result in a whole other episode, probably a whole 3 or 4 other episodes. And who knows, maybe I'll expand on it down the road. But for now, here is the short answer. The only ways to prevent these moral hazards is to either A, get government out of the financial markets because their intervention and manipulative incentives distort the true prices and risks of the market. Or B, fund government regulatory agencies better so they have the funds to better conduct oversight of the markets, hire better talent, and fight corruption. So it's a classic battle of small government versus big government. Right now we have big government that is at the beck and call of those with the money, which is not good for the rest of us. Obviously, when things go bad, people like a big government that can step in to fix things and not have to wait for the free market to fix itself, because that uncertainty is nerve-wracking. In the end, markets go up and down, but if moral hazards are eliminated or reduced, they won't go up and down with the same sort of violent trajectory as we have become accustomed to seeing. Thank you so much for watching another episode. You can find new and classic episodes of Mo Money right here on YouTube. For now, don't forget to like, comment, subscribe, share, follow me on Twitter, follow me on Instagram, like me on Facebook. Mo Money signing out.